Okay, in this module, we're going to talk about revenues. Module 5, the book talks about three topics: revenues, receivables, and what else is in here? Revenues, receivables, and operating expenses. Okay, so I'm probably going to break this down. I tried to make this Friday and it kicked me out after about 40 minutes. So I'm going to break it down into some shorter ones. So this will be just on the revenues part of things. And so revenue, we use the accrual form of accounting, which means that we book a revenue when it's earned, and then we book an expense when it is incurred. So it has almost nothing to do with when money actually changes hands. So I could ship you 10,000 blue widgets and give you 30 days to pay, but once I've shipped the widgets, and the title transfers to you, then I can book the revenue. I have done my part. Likewise, if I sell you a color TV, right? I book the expense as cost of goods sold. I book that revenue when you walk out the door with it, right? And you may have 30 days, 90 days to pay me, but there's a promotion or something going on. But I'm booking that expense now, and but I may have paid for that 3-4 months ago, and it's been sitting in inventory, right? So the change of hands of money has nothing to do when a revenue is earned or when an expense is incurred. And that brings me up to one point I'd like to make. One of the principles we use in accounting is called the matching principle. So we try to match our revenues and our expenses together. So when I sold you that TV, I'm booking a revenue for a sale, let's say $500, and then I have a cost of goods sold, which is an expense, let's say at $350. So that gives me a gross profit of $150, the 500 minus the 350. So my revenue and my expense are matched during that time. Now we can't match all expenses to revenues. For example, if I pay a watchman to watch the building at night when no one's there, when I pay them their salary, there may not have been a revenue involved there. So I can't match every expense to revenue, but I try to match them as closely as possible. Okay, so your book has this 5-step revenue recognition principle, and this came about somewhere we started teaching it about 10 years ago, knowing that it was going to come out. It had already been approved for adoption, and it would be adopted like 2 years later. So we started teaching about 2 years ago, 10 years ago, and it was adopted about 8 years ago. And this revenue recognition format that FASB puts out now, Financial Accounting Standards Board puts out now, is due to the fact that business is much more complex than it ever used to be. We get all sorts of goods and services mixed, and everything has its trade-offs. But I'm going to show you the old way to do it, and I'm not doing that for a history lesson, because you can use anything that is like a single good or a single set of goods. Like you go to the grocery store, you may have 40 things in your basket, right? But all of them are a good that you're taking out of there. There's no service involved. Um, you just you check out, you pay the cashier, and somebody bags your groceries. I'm considering that a de minimis service. It's not really part of why you're going. Some places you bag your own groceries, but um, so they bag your groceries, and you walk it out to your car and go. There's no service beyond that. Nobody's coming to cook the dinner. Nobody's coming to stock the refrigerator. Nobody's coming to make sure the food is still good, a week later after you buy it. None of that's going on. So it's just when you have a single type thing, either it's all service or it's all goods, you can follow this 3-step process and it will work. And it will honestly work about 99% of the time. So it makes life a little bit simpler to do that. So number one is, has the good been transferred or the service performed? That's number one. Okay, so obviously you can come in and put a deposit down on something I'm going to do for you. I'm a tax accountant, so you come to me and you say, I'd like you to do my tax return again this year. And I'm like, no, dude, you didn't pay me for 6 months. You go, well, you did a really good job. Sure you won't do it again? I go, okay, I'll do it again, but you got to pay me up front. I need a check right now for $1,800 or whatever the tax return was worth. And I say, fine. Well, obviously, the service has not been performed. I haven't prepared the tax return yet, even though cash has changed hands. So I can't book a revenue. I actually have a liability, right? So has the good been transferred or the service performed? Number two, do I have a reasonable expectation of payment? Well, obviously, if you paid me in advance, or if it's like the grocery store example, you paid me, you put up your debit card, it was approved, I'm getting paid, you take the goods, obviously payments. But most business in this country is business to business. I would guess probably 95% of the total business in this country is business to business, maybe 90. So I call you up. I'm a manufacturer. You're a supplier. I call you up. You ship it to me. And of that business to business, the vast majority, 99% plus, is done on what we call trade credit. You send it to me, and then you give me 30 days to pay, right? And if you think back to our ratio back there, we had one. I won't test you on it, I promise that. But if you think back to our ratios, we had that CCC, where the currency clearing thing. So, we could we could actually get money before we had to pay. The absolute gem of this, and it's why Warren Buffett, he's retired now, but why Warren Buffett always liked the insurance industry so much, because you get paid first and you get to use that money sometimes for years before you have to provide the service, right? And so so he got to invest and make money and do all that kind of stuff on what we call the float. the money that will be an expense at some point, in the insurance business, but it's not yet, and so we can invest it. So do I have a reasonable expectation of payment? Not every business does. Criminal defense attorneys routinely only collect about 25% of what they book in revenues. Or, well, they shouldn't book it in revenues, but what they bill. That's just the nature of that business. Sometimes we know we won't get paid, but and this is true of early life cycle things where it's winner take all or winner take most. We just want market share, because if we become the de facto standard, it's okay if we don't get paid by a bunch of our clientele, because we've run everybody else out of business. Adobe did that, right? They gave away the Adobe Reader, and you had to buy Adobe Acrobat. If you first wanted to start doing PDF files, you had to you had to buy the Adobe Acrobat, and they didn't care if a bunch of the people didn't pay them, because their marketing strategy made them the de facto standard. Same was true with Microsoft, although there were a lot of tech companies that went out of business and they never got paid for some of their stuff too. So do I have a reasonable expectation of payment? Yes. And then third, and this one's going to sound a little funny, do I know the value or are able to estimate it? And I think the best example of that, something you're all aware of, is car dealerships. When they start out on the new year, they start buying cars and stuff. But what a car dealer pays to the manufacturer, either Ford or GM or Hyundai or Toyota or whoever it might be, what they pay depends on what their purchase volume is. They get discounts all along the way. So in the early part of the year, that car that costs them $25,000 may, after all the rebates and everything, may only cost them $21,000. Right? And so when they buy that car in February from Ford isn't 100% sure what they're going to get paid. Now, if they've got a dealer that has maxed out their rebates and everything for 10 years running, they pretty much know. If they've got somebody that's never hit a discount, they know, right? And so can they make a reasonable estimate? And I guarantee you, overall, they can make a good estimate. They know that on average, they're going to pay a 10% rebate, so $2,500. So when they sell that car for $25,000 to a dealer, they can book $2,250, knowing that they're going to rebate 10% on average, right? So what we bill is not always what we book. There are other things, we talked about the bonus situation, but there are other things where values are tied to other contracts or stuff. If the stock price is such and such, get that. In the hedge fund community, it's 2 and 20. You get 2% of the assets and 20% of the increase. Well, what's that increase going to be? Right? You don't know. Do I know the value, or am I able to estimate? So that's the old way of doing it. Now, let me go back up here to number one when we talk about, has the good been transferred or the service performed? And this is particularly true with goods, much more so than service. services. Has the good been transferred? So there are a number of things. One is called FOB. That stands for free on board, and it means that the title transfers once I put it on the truck, the delivery vehicle. Right. So once it leaves my shipping dock onto the truck, out my door, that's when the title transfers. FOB, free on board. So it becomes a revenue as soon as I load it on the truck. There is also FOB destination. And so this, um, the title transfers when it comes off the truck. This is generally used for companies that have their own delivery vehicles. My wife used to be in the clothing business, and there was a company out of Dallas that we used for supplies. I say clothing business, the custom clothing business. She made dresses and suits and knockoffs for wealthy ladies that of designer type clothing, or they liked it but they want this changed or something like that. And this company would ship it on their own trucks. They just had a regular weekly route, and so we always we'd get in the orders by Friday, and by Tuesday it would be delivered to her doorstep, her shop doorstep. And of course, they would carry some staples. And this company was in the business of supplying like cleaners and people like my wife, custom clothing people, that sort of thing. And they would have staples like threads and this and that. And so you could buy a few things off the truck, but not much. Mostly it was the orders and stuff like that. And we did quite a bit of business with. I mean, by our standards, quite a bit of business. To them, I'm sure we were a pain in the rear, but it was a couple $1,000s a month that we were paying them for various goods, and we would they had the best prices on capital goods. And the thing that went out in that business was irons a lot, and presses and irons and stuff like that. So we would probably have to buy about an iron every 8 or 9 months, and those commercial irons are very expensive. So uh, so anyway, FOB destination. So those are pretty clear. If you get into international trade, then it will transfer at some some point in the middle of the ocean. And a lot of that has to do with maritime insurance and all this kind of stuff. There is another one called bill and hold. Bill and hold is when I bill you, but I don't ship it. You ordered it; it's yours, but now you don't want delivery yet. This happens a lot for like seasonal things. If you don't order by Christmas stuff by March or April, you're probably not going to be in line, or you're going to pay more for it. So I'll bill you for it now, and you may or may not pay me, but I'm not going to ship it to you until August, right? We do not get to book the revenue until it is shipped. There's another one called right of return. The formal name is right of return. When it gets overdone and it stretches into the fraudulent phase, then we call it channel stuffing. But right of return just means, here, you take it, pay me for it, but no problems. If you can't sell it in 6 months, just send it back to me. I'll credit your account, or I'll give you your money back, or whatever it happens to be, right? American Optical, which is one of my favorite sunglass brands, they got into this big time and got slapped on the wrist by the SEC for sending all these sunglasses out to people. Oh, it's not a problem. They were booking the revenues, even though they had the right to return. There is consignment. Consignment is this has become popular the last 20 years. It's not a short thing now, but women's clothing resale. A lot of women like to only wear things one or two times, and then they don't want to be seen in it again. I'm not judging it. I just don't get it. But it seems to be a very common thing. But in a consignment, the consignment shop acts as your agent. They never actually have title of it. So somebody comes into the consignment shop, sees that dress, they buy it. The consignment shop never had title. It went from the owner to the new owner, and the consignment shop owner never had title. They are just a agent. And so not only do they not book the revenue until it's sold and taken out of the store, they don't ever book the full revenue. Like, let's say that the dress was to sell for $100, and I have a 25% fee on that. I don't book $100 revenue. I only book a $25 revenue as the consignment shop, right? Because I never had title. The only thing I got was the service of displaying it and handling the final sale. Okay, so those are some of the basics of that sort of thing. When we have our accounting students, we drill them pretty hard on this. There's a lot of auditing issues that can occur, especially with the channel stuffing and the free on boards. I put it on board the truck on December 31st, but it's free on board destination when I book the revenue. Well, I don't get to book the revenue until January 3rd. So, all those sorts of things kind of happen. So that leads us to the 5-step process that your book talks about. Number 1, identify the contract. With the customer. Now, I know a lot of you haven't had your business law yet. That's perfectly okay. But a contract does not have to be a written contract. It can be a verbal agreement. You can have a contract just on your actions. If I walk into a convenience store, go to the back wall, pull a Coke out of the refrigerator, the cooler back there, walk it up to the front counter. The cashier scans it. They tell me, $2.49 is what I owe. I take a $5 bill out of my pocket, hand it to him, never say a word, right? And he hands me back the change, and I proceed to walk out the store. Do I have a contract? Absolutely. Based on my actions, I made it clear that I wanted the Coke and that he was willing to charge, and I was willing to pay for it because I did pay for it, right? So just remember, contracts do not have to be written. They don't have to be oral. They can be by action, by our demeanor, by our action. You can have a contract with a customer. Okay. 2, this is the one where business has gotten more complex. Identify the performance obligations. Now, performance obligation. I'm going to make this easy. Obviously, if I go in and buy the Coke at the convenience store, their performance obligation is to provide me a Coke. And that's the end of the performance obligation, right? We're done. I can pay for it with a debit card. I can pay for it with cash. I can pay for it with a credit card, you know. But once I get the Coke and I paid for it, we're done. That's the performance obligation. That's about as simple as it can get. On the other hand, business has gotten more complex. We have a lot of software as service. So I can buy a piece of software and have maintenance and updates for 2 years when I buy that software. And so now I have two different performance obligations, right? I have the software itself, and then I have the maintenance and updates. Those are two separate performance obligations. I think the best one, it's not too long ago, I think most of you will remember this. The model in the cell phone industry was that you sign a 2-year contract and you would get a free cell phone. All right. Okay. In accounting sense, it's not free. We have to divide that into performance obligation. So you have a 2-year service contract and you get a cell phone, two separate performance obligations. One is a good, one is a service, right? So those are the performance obligations there. So now I have to determine the transaction price. All right, let's say that my contract for the cell phone is $50 a month for service for 2 years. Therefore, my contract price is $1,200, right? I pay $50 a month. Now, there could be overages and other fees and stuff like that, but that actually becomes new performance obligations. You know, if I go out of the country and I get a worldwide roaming plan, something like that, right? Those sorts of things are add-ons. But determine the transaction price. And then this one is what gets hard, is allocate the transaction price to the performance obligations. Okay, so we've got these. So we've got that $1,200 for the cell phone. How much goes to the cell phone, and how much goes to the service? Well, there are different ways to determine that based upon what you know. If both things are priced separate, if you can determine a price. So if I can go into the phone store, the ACCT or whatever, T-Mobile or Verizon store, and buy a cell phone without a contract, just pay out cash for it, that is a purchase price. If I can sign up for a service without buying a monthly service, without buying a cell phone, without getting a cell phone for it, I have a price for that. So now I have two separate prices. Now, obviously, the idea was when they were doing this is that you got a bargain by getting both at the same time. So what we do is we prorate it. Let's say that the cell phone cost $800 as a standalone price, and the service cost $30 a month as a standalone price without the cell phone, right? So then I would have $720 and $800, and so I would prorate that 720 over 1520, right, times the 1200 would give me the service, And 800 over 1520 times 1200 would give me the cell phone. So I would book the cell phone revenue when I handed the phone to them, and I would book the service revenue each and every month on a pro rata basis. Well, that's a pretty straightforward one. What if I can't? What if I only have the price of one? Well, let's say that only there is no service without buying the cell phone. You can buy a cell phone without the service, but you can't buy the service can't buy the service without the cell phone. If that's the case, then I attribute the price to the standalone price. So of that 1200, 800 would go to the cell phone, right? The standalone price. And the other 400, the remaining out of that 1200, would be allocated over 24 months as the service price. Right? So that's if I only know one of the two prices. I can do it that way. And then it comes up that you don't really have separate prices for either one. And this generally comes up in things like government contracts. Nobody's done it before. Nobody else is going to do it. Sometimes there's only a couple of bidders, maybe only one bidder, bidless contracts, various things. And so now you're just going to have to allocate it based on the facts and circumstances. So allocating the transaction price to the performance obligations is one of the toughest things we have to do. And then finally, we have to recognize the revenue. As the performance obligations are fulfilled. So, or satisfy, your book uses the word satisfied here. So once I start satisfying those, I start doing obligations. Okay. A couple of other things I'd like to talk about revenue, two in particular. If we sell on credit, not everybody is going to pay us. And we can prove, just take my word for it. But, it's pretty well given that if I have my credit standards so tight that nobody ever defaults, I'm probably losing a significant amount of sales. And so we can prove that if we set our credit standards a little bit looser, suffer a few, 2 or 3% default rate, that my sales, my gross profit increase will outpace my lost cost of goods sold amount in that. Just take my word for that for now. And so what we have to do is we have to set up an account for sales returns and allowances. All right. I was actually drifting off into the accounts receivable, which is next. But okay, so sales returns and allowances. Sales returns are pretty obvious. Your mother-in-law gives you a gift at Christmas time, and you say, "Oh, you shouldn't have," and what you're really thinking is, "Oh, you shouldn't have." And so anyway, you find out where she bought it, you return it, you get the money, and you buy what you really wanted. Everybody's happy, all right? So that's a return. That's pretty obvious. Or you get home and it doesn't fit. I will admit I'm guilty. I go to Home Depot or Lowe's somewhere, and I need I get there and I can't remember if I need a 1-inch or 1.5-inch screw. Well, I need this thing fixed. Whatever I'm working on, I need this thing fixed. So I'm going to buy both. And when I get back to the house, I'll figure out which one I need. And my next trip to Lowe's, I'll I'll take it back and return it, right? I've done that before. Generally, what happens is my next trip to Lowe's is so far down the road that I forget about it. And so now I have a storage of screws of different sizes. And that's fine. But sales return is pretty self-explanatory. The sales allowance, on the other hand, is when you call me up and you say, Wayne, I need 10,000 blue widgets. And I say, no problem, I'll ship them out. And so the next morning I have 10,000 green widgets in the mail. You ask for blue. You get them. You get them to me, or you get them and you open them up and they're green widgets. And you call me up on the phone because you're pressed for a deadline and you got all this stress and, all this kind of fun stuff. And you call me up and say, you sorry SOB, blah, blah, blah. You sent me green widgets. I need blue widgets. I specifically asked for blue widgets. You said you'd send me blue widgets. You low life, no good. I'm like, wait a minute. It's an honest mistake. I didn't mean to send you green widgets, because I can send you the blue widgets. It'll take a couple of days to get to you. Or I'll tell you what, if you can use green widgets in their place, I'll knock 15%. You say, well, they don't really show. Yeah. Okay, I'll take that. That's a sales allowance. I have allowed you a discount because of something I did on my part that wasn't correct. That is a sales allowance. So we have to when we book our revenue, or not when we book them, but when we issue financial statements, we have to have a little bit for sales returns and allowances on our revenues. And we know historically what that's going to be. It's going to be 0.5%, 1%, 5%, depending on the industry, et cetera, right? All right. So, okay, let me also talk about unearned revenue. So, like the example I gave you, somebody comes in and asks me to do their tax return. I say, dude, you didn't pay me for 6 months last year. And you say, I'll pay you up front. Okay. So now I book the revenue. So what I'm going to have, I'm not going to book the revenue. My journal entry is going to be cash, because cash came in, let's say $1,800, and I'm going to have unearned revenue. Now, I call these masquerade accounts because it takes the last name revenue, so we think revenue, but it's not. This is actually a liability, okay? Because I owe you either a tax return or I owe you your $1,800 back. So, next week, before I get to start on your tax return, I get in a car accident and I'm laid up in the hospital. It's going to be a couple of months of therapy before I'm back to work. And so I tell, whoever, call up Fred and give them their money back. I won't be able to get to it in time. Right? I can satisfy it that way. Or nothing happens and I fill out the tax return, do everything I'm supposed to do, and have it ready for them. And once they sign off on it, I transmit it electronically, and here we go. And I satisfied the revenue that way. I've satisfied the liability that way. So not all liabilities have to be settled in cash. They can be settled in service or good or whatever. When I have a deposit is an unearned revenue, right? So you come in, you want a special order. So basically, I'm going to make you pay the deposit for the parts. So at least I'm not out the parts. And then when I put it together, you come in and you pay me the rest, right? So now that unearned revenue. So let's look in this case. What happens when I do the tax return now, and the client comes in to pick it up? Now my journal entry is unearned revenue for 1,800. So these wipe each other out, right? And then I have service revenue. $1,800, and that's that would be my journal entry to show that I fulfilled that revenue with a yeah. All right, so let's stop there on revenues, and then we'll get to accounts receivable.